Cool. All right. Thank you all of you who have taken your time out of your busy schedule to join us in this evening webinar, What Property Buyers Need to Know About UK Tax Regime. In today's discussion, we are very happy to have two guest speakers who will be able to give a pretty thorough explanation on the most common scenarios presented to us, accumulated from our dealings with our clients, and those our clients are Singapore and Malaysian as well. So it's very, very relatable to you. I will be your moderator today. Thank God I don't need to present, but I will present later on the project. My name is Shelvin. I'm from RBC. We are a marketing consultancy company based in KL, and I have over 16 years of experience dealing with international buyers in various global markets such as UK, Australia, Singapore, and Japan. I am joined by Miss Honey from Rhythm Shuffles, who has been representing Malaysian and Singaporean clients as the buyer solicitor who are buying into the UK property market. Honey will cover some of the tax aspect from a conveyancing point of view. In addition to Honey, we also have tax expert Christine from Duke Taxation, who will be adding depth to our discussion as far as to the possible exemptions an overseas investor could get. As we know, everyone's circumstances are indeed different and personal. So what we will cover today are common scenarios which we have come across often in our line of work. It is at no point a re-representation of your tax situation, and we will encourage post-webinar or seminar discussion to provide accurate advice to you. So, without further ado, let's dive right in. UK Tax 101. So there are a couple of taxes that we should take note. There will be few terms which you will see us repeating throughout the discussion, but please allow me to state them here for those who are not yet familiar. We'll be taking you through this with a few scenarios to help you to understand. And as we get along, please feel free to jot down any question you may have in our chat room, and we will answer them as best as we can along the way or at the end of the session. Now, 1, 2, 3, 4, 5. So there are 5 items for us to take note from here. Stamp duty, land tax, income tax, capital gain tax, inheritance tax, very hot topic, and also personal income allowance. These are our favorite as well, because that helps us to save money. Now, questions to Honey. Stamp duty, land tax, you are basically quite an expert in this aspect of work. When do you usually need to assess the buyer's position when it comes to stamp duty calculation, and what are the variables?
Firstly, I want to say thank you so much for having me in this webinar. So a lot of people ask me questions such as, when is stamp duty payable? Is it when at the beginning, or during the transaction, or at the end of the purchase? So stamp duty land tax is payable only on legal completion, meaning the property is already completed and you've already got your keys. So that's when you pay stamp duty, within 14 days of that date of completion.
And do you usually assess their eligibility in order to understand the amount they should pay, and what sort of period are we looking at, like couple of months before completion or weeks before completion?
So in order for us to determine our client's stamp duty land tax, so we will raise several questions to them prior to completion, and most of the questions relate to their current circumstances at the time of legal completion. So, for instance, whether they are a UK resident or whether they are not UK residents, whether they have already owned properties worldwide, or it will be their first time purchasing a property. And also bearing in mind, we will need to know whether that property will be their main residence or not. So all these questions and all the replies will enable us to determine what sort of stamp duty you'll be paying at the time of completion.
Understand. Okay, very, very clearly stated. Now, when it comes to income tax and capital gains tax, okay, let's do it one by one. When we are overseas landlord, and when your property in the UK are being rented out and generates income rental income to you, then you are subject to pay income tax in the UK. And okay, question to Christine. When is the financial year in the UK? Usually in the year.
Yeah, okay, so yes, good evening, everyone, and thank you, Shelvin, for having me here. So the very common question, okay, so when is income tax payable? It's so the deadline for paying income tax as well as the filing of your tax return falls on the 31st of January every year if it is an online filing. So
Okay.
we have some people asking whether they can do paper filing themselves. So the deadline for that will be 31st October every year.
So if they are opting paper filing method, they would have to print out the form and fill out themselves, and they have to courier back to HMRC. Is that correct?
Yes, correct.
Right. That's very, very, very manual. So it's best that to engage Christine or do taxation tax agent who are experienced in terms of filing, and they know what kind of expenses and relief you can enjoy. Before we dive into that, is there any different rate between UK tax residents and non-UK tax residents?
Okay, there is practically no difference. So for the income tax rates, there are 3 levels. So the first basic rate is 20%, and that will be for the first £37,700. But if you qualify for the personal allowance that is in the last column there, then it would be £50,750.
Yeah, as we can see, the 12,570 is for per person per annum per year. Okay, and Malaysians are entitled, but Singaporeans are not entitled. Okay, but that's basically putting us in a more advantageous position to buy a property in the UK, and if you intend to buy for investment. Now, let's dive into a bit more on stamp duty first. I'll let the professional Hani to go through the different rates according to circumstances. So over to you, Hani.
So stamp duty, how it's calculated is based on a progressive system. So as you can see on the table below, that each band will be, sorry, I do apologize. Each portion of the purchase price will be charged according to the several rates, several bands. So up to, for instance, if you scroll down up to 250,000, it'll be 0%. That's the usual rate. And then from 250,000 to up to 925,000, it's 5%. And from 925,000 to 1.5 million is 10%. And above that will be 12%.
Okay.
That is just the standard rate. That's what we call it, the usual standard rate. However, as you can see on the next column, if you do own additional properties, and this is considered worldwide, not just in the UK, then there'll be an additional 3% surcharge that you'll need to add on each band. And on top of, so that will be 3% if you own an additional property worldwide. And also, if you are a non-UK resident, you will also have to add in another additional 2% surcharge on top of that. So effectively, if you own other properties, for instance, in Malaysia, and obviously you're a non-UK resident, then ultimately up to 250,000, you have to pay 5%. And from 250 to 925,000, up to 10% and so forth.
Okay. Can you give us a bit more insights on the definition of being a UK tax resident? Do we need to hold a British passport?
Not necessarily. So in order to be classified as a UK tax resident, you will need to spend up to 183 days in the UK within that tax year. You'll need to be working full time in the UK, paying the taxes, and also the property that you're purchasing. is your main residence. So essentially, that's where you're going to be living, and you pay all the, utility bills and all the other expenses. So that's when you're considered as a UK tax resident.
Okay, that makes it very friendly place for us to enjoy some discounts if we were to stay in the UK for more than 183 days in a year. Okay, good. Let's move on. We're going to discuss some scenarios, case studies. Again, we are taking from most common scenarios that we have come across from our line of work. We're going to start with scenario number 1. You are a first-time buyer into UK property market for investment purpose. You do not hold any residency in the UK. Now here comes the details. Property purchase price £400,000. And in the contract, we have a married couple. Husband and wife's name are in the contract. Residency status, they are non-UK residents. Let's put them as Malaysian, okay? They do not have any other properties to their name. So basically, this will be their first home, first property worldwide. And because it is actually buying for investment, hence they're getting a rent income of about 20,400 per annum. And there is also a series of related expenses. We just for example basis, it's 5,200. That includes, say for example, service charge from the property and the letting and management agency. So 5 years down the road, you decide to sell the property at £480,000. And the related expenses incurred from the sales is at 11,500. Anyway, they are all for illustration purpose. They are not exact amount. But the sales of, the expenses that comes from the sales are potentially the agent fee and also legal fee. Now, we are also putting in a table for IHT, but we'll get to that later on when it comes to mitigation process. Stamp duty land tax upon purchase of this 400,000 property. Because they are non-UK residents, so Hani, correct me if I'm wrong, they are charged the 2% surcharge as foreign buyer.
Correct.
But they also enjoy some discount because it's their first property worldwide.
Okay, so yes, correct. They will have the benefit of the for up to 425,000
Good.
threshold basically. So anything above that, first time buyer rate, you'll attract the 5%, this 5% flat rate.
Okay, cool. And also when it comes to ownership structure, there are 2 options for them to consider. One being joint tenants and another one being tenant in common. Okay, this is just a very legal term. Tenant doesn't mean you are going to be the tenant and somebody else to be a landlord. You still own the property, but because most likely you're buying into a leasehold property. And in the lease agreement, your position in this contract, you are actually a tenant, but you are still the property owner. So when it comes to the sales and purchase agreement itself, you are being addressed as a tenant. Tenant in common and joint tenants, perhaps I leave it to Hani to explain the definition behind these 2. Then we can get to the income tax and capital gain tax calculation.
Okay, so essentially this is how you wish to hold the equitable interest of the property. You can either hold it as joint tenants or tenants in common. Usually with family members, husband and wives, relatives, you wish to hold it as joint tenants because if one purchaser passes, their share will automatically go to the surviving. So with tenants in common, this is usually opted for some, for instance, friends, 2 friends, they decide to purchase a property together. So they may want to opt as tenants in common. So if one purchaser passes, their share will be distributed according to his or her will. So each person will have their separate shares, basically.
Okay. When it comes to this scenario, Christine, I'm sure husband and wife usually is 50-50. Like I don't see any having a very different, like 30% to husband, 70% to wife, unless it's a very personal discussion. Okay, let's put it as a 50-50. Hence why when it comes to income tax, I suppose you have to divide the income by half according to portion, according to percentage. So can you explain this in depth with us, and why it is, is appeared to be a negative amount?
Yeah, okay. So the net profits will actually be divided amongst the two owners. So we have assumed 50-50. So the
So the income
22,000.
and expenses are being divided by half, and
Yeah.
then but the personal allowance are like a full amount per tax file. So that is actually the benefit, I suppose.
Yes, yes. So let's say in this example, the net profit, net taxable profit is actually 15,200. Okay. So, and then if you divide it by two, it's 7,600 per person, and that is less than the personal allowance amount. So the net effect is actually negative, but then when we report it to the KHMRC, the UK tax authorities, it's actually nil income, so there is no tax payable.
No tax payable, and a lot of Malaysian clients, they thought they don't even need to file the tax, but the fact is you still have to file the tax, right? Okay,
Yeah,
so
yeah,
please,
yeah.
please, ladies and gentlemen, please take note. Even though your taxable income appears to be a negative amount, that doesn't warrant you, the grace period, or rather exempt you from doing the filing. You still have to do the filing. So due tax by Christine, if you engage Christine, she will help you to do all the paperwork and submit to HMRC. Okay.
Yeah, so let me just jump in here. No tax payable doesn't mean you don't have any filing obligations. So these two are actually very separate things.
I see. Okay, so if we go to the capital gains tax, essentially it's the same characteristic, right? Because again, it go according to the ownership percentage, the portion. Then obviously under these circumstances, it's 50-50. So everything also divided by half. Okay. Can you explain to us this 6,000 amount? What is this for?
Okay, the £6,000 is an annual exemption that is available to all taxpayers, no matter you are resident or non-resident of the UK. So if let's say if you sell two properties, for example, in a year, in the same tax year, it will still be £6,000. So it doesn't go up to £12,000. So it's it's per tax year. It's an allowance per tax year.
And this capital gains tax rate doesn't vary according to the holding period from completion, right? Because in Malaysia, we have different rates according to how many years you hold the property for. Like say, for example, if you hold the property for 3 years, then your capital gain tax is this X amount of percentage. But in UK, is it like a flat rate, irregardless the holding period of the property?
Yeah, correct. So it's it's either 18% or 28%. So 18 is the basic rate, and if you go to the next bracket, it will be 28%.
Right. Okay. And this capital gain tax rate is following your income tax band rate. Am I correct to say that?
Yes, that's correct. Yeah.
Okay.
So one more thing on the filing of capital gains tax return, it's actually a separate return from income tax return. So there is a specific deadline for the filing of capital gains tax return, which is 60 days after the completion of the sale of the property. And if there is any tax due, it will have to be paid within that 60 days as well.
So if someone procrastinate and they file after 60 days, what would happen? Would they get penalty from the HMRC?
Late filing penalty, yes, as is the same for income tax returns. So it's £100.
That will most likely happen to me. So I will try not to procrastinate. Okay. Take note, do not procrastinate. Please follow the tax filing period. Okay. I think it's quite well explained here. IHT, this is very similar to our Malaysian law. Upon death, if it's a spousal transfer, then there won't be any transfer tax. Eventually, unfortunately, you all die lah. And in this instance where even one of the spouses passes first and the asset is passed on to the surviving spouse, there is actually an allowance of 325,000 pounds as a tax-free amount onto the surviving spouse. The surviving spouse will carry a total allowance of 650,000 pounds, which he or she can either use for 7 years survival rule to pass on to the children if they have any, or liquidate the asset to transfer the inheritance to their kids in other ways. So Christine will actually walk through the 7 years mitigation later in the later slide. So without further ado, I also need to share scenario number 2, which is also quite common in our case. You are a first-time buyer into UK property market for investment and children. This is like very, very relatable to a lot of Malaysian parents. It's for the children accommodation or education purpose. And your kid holds a UK residency. Okay, now, content of the story. Example, the property purchase price, 625,000 pounds. Contract under kid's name. Wow, how lucky. I wish I'm the kid. Residency status, UK residence, first time buyer, and he or she is staying in the property. So they do not have any other properties to their names. They receive an income of 20,400. The annual related expenses are estimated to be this is wrong because they are staying in the property. So they don't have any income. Sorry, can you just disregard this? But let's start from here. 5 years later, you decide to sell the property at 750,000 pounds. And the related expenses coming from the sales of the property is at 18,000. And we also put an illustration for IHT. Now, stamp duty. Oh, very low. It's only 10,000. Honey, over to you. So why being so low?
Well, because the kid, the lucky child, is a first-time buyer, doesn't own any property worldwide. He's going to be a UK resident at the time of legal completion, and that will be his main residence. So, as I was saying earlier, he will benefit from the first-time buyer rate, which is 0% up to 425,000. Anything from 425 to 625,000 is 5% flat rate.
So essentially, if this kid or the parents buy into a property that is beyond 625,000 pounds, it will fall back to the basic rate lah. Basically,
Correct. It will go back to the
relief.
standard rate.
Right. Okay. So yeah, that's very, very important note for you to take, ladies and gentlemen. But also given that you must live in, and this has to be your main residence. It can't be any for any investment purpose, or you
put it to benefit.
Yeah. So the name and the address, the name has to be the kid's name and under the address as well. So that's how the government assess the criteria. So effective rate is 1.6, very low. Because when it comes to income tax, because it's actually a main principal residence, there is no income from the rental. Hence no tax payable under income tax, save the work. And this is interesting. If he or she sells a property, there is no capital gains tax because it was his or her main home for the whole duration of ownership. Christine, would you like to explain a bit more on this?
Yeah, so this is called the principal residence relief. So if the election is made for this home to be the main home of the owner, so say your child, then no capital gains tax will be due when the property is sold.
Okay. Can I just revisit the SDLT, because I remember seeing a questions regarding to this this aspect of tax. Honey, you actually shared with me that there was client who actually got a refund when they move home. Can you give us a bit more insight on this case?
Okay, so what happened was a client of mine obviously was residing at her main residence, a flat.
Right.
And she was staying, that was her main residence, her first property. She was residing there for, I don't know, 3 to 4 years. And then she decided to, time's changing, so she decided to get a bigger place. So
Mm.
at the time when she bought the second property, obviously, when she paid the stamp duty on the second property, the additional 3% would have kicked in, right?
Ah,
Because
yeah, yeah.
she still had her flat, her first flat, and when she bought her second home. So when she
Mm.
paid the stamp duty on the second home, the 3% kicked in. But there is a rule that said if you sell your main residence within 3 years of completion of within 3 years of completion of the second property, you can get a refund back of that additional 3% that you paid on that second purchase.
That's wonderful. So the process of getting a refund is not difficult, right? What would
No,
she or she have to do?
they'll just go online. I believe you fill out a form and then you'll just have to wait until Inland Revenue contacts you.
Ah, okay, okay. That's pretty important point to take as well. Okay, good. Okay, in this case, inheritance tax. On this basis, there is no inheritance planning is being carried out. And in the event that there is a will to pass the assets to the kid's future partner or wife, there is no inheritance tax being payable. And as mentioned, the inheritance tax allowance is being passed on to the spouse as well. So, and also if the property is being used as a main principal residence, there is an additional inheritance tax allowance of £175,000 here, stated here, on top of the £325,000 tax relief. So it makes it £500,000 tax relief per person. So it is not a scary topic. I think a lot of Malaysian and Singaporean investors are very wary of this tax rate because it's 40%. But there are ways to mitigate because the tax relief amount is quite good. And there are also methods for you to mitigate, which Christine will go through with us later on. Let's jump on scenario number 3. You are a multiple property buyer. That applies to a lot of people because we all love buying properties. And into the UK property market for investment, and you do not hold any UK residency. Content of the story: purchase price £600,000, husband and wife's name in the contract, residence status non-UK residents. They have other properties to their name, and they receive an income of £30,000 per annum as the rental income. The annual related expenses are £7,100. 5 years later, they decide to sell the property at £720,000. Cost from the sales is around £17,000. Same thing, the table, the magic table. Stamp duty land tax when they bought the property at £600,000. As you can see, there is quite a different rate. I wouldn't say a high rate, but considered very reasonable. So essentially is the main difference here is whether you are a UK resident or a non-UK resident, and also whether you have more than one property worldwide.
Other
Is that correct?
properties. Yes. Yes.
Okay.
So mainly it determines whether you're a UK resident or not at the time of completion and whether you own other properties at the time of legal completion. So you could have exchanged contracts, just say 2023, and you own a house in Malaysia, but then completion is in 3 to 4 years. But then within that time frame, you sold your property in Malaysia, started to rent instead. And then at the time of legal completion, you will have to declare that you don't own any of the properties. So essentially, you won't have to pay the 3%. And I just wanted to add that spouses are considered as one entity. So, just say your wife doesn't own any property, and she wants to benefit from the first-time buyer rate. But unfortunately, if her husband has already owned previously, then that entitlement is essentially withdrawn, basically. They will have
Okay.
lost that entitlement.
I see. Okay. Okay. Also very, very crucial point for you to take note before and always make informed decision, because usually we will see couples buying property together. Please make sure that the both of you align your thought process before you make any decision to buy property together. Now it comes to income tax and capital gains tax. Very similar to scenario number one, Christine, because all divided into 50-50. No tax payable on the income tax because they are still achieving negative gearing. Capital gains tax also very similar, also enjoying 6,000 capital allowance. And then there is an effective rate at 19.7%. Okay. I don't think we should dive in more into this because it has been quite covered on scenario number one, unless, I think when it comes to income tax, because they are multi-unit owner in the UK. So if they have two properties, then the rental income would be compound, right? It has to be grouped together, right? Okay.
Yes.
Then only you have this 12,570 as your personal allowance. You can't double this because it's for one tax file per year.
Yeah. And it's for
then correct. And again, if the husband passes his share to the wife, there's no IHT payable between spouses. Okay. If you think there is a significant jump in stamp duty, you are not wrong, but we also need to put things in perspective when we are dealing with buying properties as a foreigner. So on the next slide, I will show you the comparison between London and with other global cities. This is a very interesting table. I'm sure everyone heard about Singapore. The market is going cray-cray, hence why they are putting a huge cooling measure against foreigners. Yet people are still buying. Let me just share the very fact about Singapore market is people are still going in. The PRC are still buying up. The British people are also buying in. So even for Indonesian tycoons and all, they are also still buying into Singapore property. And you will see that 60% is, I'm just addressing the surcharge against foreigners. That has not included the base rate. So 60% definitely is number one in the world, Singapore. Okay, that one heads down, number one. Then we have Hong Kong at 15%, Melbourne 8% surcharge, and that they have a base rate at 5.5, so it's add on about 13.5. London is only 2%. Very attractive rate, I would say. So in our views, having dealt with UK property for so many years, the SDLT implemented by the UK government isn't to discourage foreign buyers. It is possibly to appease the locals, but who are actually getting priced out of a very international and buoyant market. And the UK government wanting to encourage home ownership in their country. So to put things into perspective, they are not expensive. So we're going to move on to how to possibly mitigate inheritance tax, which Christine will touch on, the 7-year survival rule and how it works. So Christine, can you please start with the overview of the UK IHT first before we take a closer look at the mitigation process?
Yeah, okay. Yes, so some facts on inheritance tax. So when you pass away, inheritance tax applies at a flat rate of 40% on your UK assets only, which are valued above this tax-free allowance of £325,000. So example, if your property is worth £525,000 and then you have this allowance of £325,000, the tax charge will be on just £200,000 at 40%, and so your tax bill will actually be £80,000. So there are two situations when you don't need to pay inheritance tax. Number one, if you leave your assets to a UK charity or political party of your choice. I don't think this will happen. Unlikely.
Very unlikely.
Impossible. Yeah, so the second one is if transfer of assets are between spouses or several partners. So there will be no inheritance tax due for transfers in life as well as upon death. So this is to an unlimited amount. So maybe next one we can see, so what are the options available to mitigate the risk of inheritance tax here? Okay, so I have 5 here, and I think I will cover more in for 1, 3, 4, and 5. So option number 2, life insurance written in trust. So this one does not actually work to reduce your inheritance tax payable, but it's more of like giving yourself peace of mind by taking life cover to fund a potential inheritance tax bill. But usually life cover is quite expensive, so it's not many of our clients will want to take this option. Yeah, so for the first one, gift while you are still alive. So gifting in life, maybe you can move to the next slide.
Yeah, yes, of course. Hang on. Sorry, lagging a bit. Okay, there we go.
Yes. Okay, so gifting in life, it does not actually give rise to an immediate charge to inheritance tax, but it's potentially exempt because it will only be completely tax-free if you survive the gift by 7 years. So this is the very famous 7-year rule in gifting that
Yeah.
Shelby was talking about just now.
Very much talk about, yeah, it's a 7-year rule. I thought it's only applied to your marriage, but also applied to inheritance.
Oh, that's it. Okay, yeah. So yeah, before I go into this 7-year rule, it's very important to remember, and I need to emphasize that the gift must be made outright on a no strings attached basis. So it's reservation without reservation of benefit. This means you cannot continue to enjoy the asset in any way, including by living in it. So if, example, you decide to give the property to your children, but you continue to receive rental income from it, this gift will not actually qualify for the exemption. And the 7-year clock will only start when you no longer retain any benefits on the property. Okay. So what happens if you don't survive the full years after gifting? So in this situation, then the taper relief will apply. And so if, as you can see in this example, you own a property of £525,000. And so after that, you decided to do some inheritance tax planning because you are getting on in age, and then you give the property to your children. So let's say if you die within the first 3 years after gifting, there will be no relief, and full inheritance tax of £80,000 will be due. So say you pass away in year 4, then this will actually be reduced by 20%, and it will just be £64,000. So year 5, year 6, year 7, and it will be additional 20% every year until you reach year 8. The property will actually no longer be in your estate for inheritance tax purposes. So if let's say you pass away, then no inheritance tax will be due at all.
Okay.
Okay, so some things that you might want to think about before gifting. So when you make a gift to another person other than your spouse, capital gains tax will actually be due on any gain that's recorded based on the market value of the property as at the date of transfer. Similarly, if there is a mortgage, then unstamped duty will also be payable. Yeah. Okay. So next up is to sell your property and export the proceeds. Okay, this is a very straightforward solution that we tend to share with our clients. So most of our clients are non-UK residents, and they are just property investors. So when you sell a property, the only tax to keep in mind is the capital gains tax that will be due on the profits at a maximum rate of 28%, as you can see previously. This is actually potentially much lower and less complicated than if inheritance tax was due. So after that, once the monies are moved out of the UK, any inheritance tax exposure will actually be eliminated.
Understand. So this is the most straightforward method, I would say.
Yeah, straightforward, very straightforward. Just move the monies
Okay.
out.
Correct, yes.
Yeah.
Okay, that's
Okay.
next slide.
Yeah, so this one other option is to stay below the tax-free threshold. As we have mentioned earlier, it's currently at £325,000. So it will remain at this level until April 2028 for now. So if there are any changes in the future, it will usually be announced through the UK budgets.
What do you foresee? What is your take? Whether it will be a higher tax relief amount or lower? Hopefully it's higher.
Hopefully they'll abolish inheritance tax altogether.
They must have. I mean, the best scenario is to not have IHT at all.
Oh
But
yes.
that's impossible lah. But I hope that they will take in view of inflations and all, right? The tax relief must increase to a better amount. £325,000 is not enough, in my honest opinion.
So typically it should actually increase every year. So by the inflation percentage, so probably like 2.5% or something like that. Hopefully.
Hopefully.
Yeah.
Okay.
So if let's say the market value of your property falls below this threshold, then of course there will be no inheritance tax due when you pass away, because it will totally be covered by this allowance. But then if let's say in this example your property value is at £1 million, then if you are the only owner, then there will be an exposure of £270,000 when you die. So it will actually help to consider joint ownership to reduce the value of your holdings. So I think if you already own a property, you can just simply add more names in it.
There will be some legal expenses, legal costs to add the name. So honey, I think do you usually get cases where clients it was a single ownership, but because of whatever reason, IHT reason, they add in the children's name or the spouse name, there will be a legal cost incur, right?
Yes, so essentially stamp duty will be applicable for that portion of that person coming in, deducting any other mortgages which is on the title itself. But essentially, if you're adding,
unless they are doing it during the construction period through an assignment method, then there won't be any stamp duty incurred, right?
correct. So stamp duty is only payable once the property is completed, finished. So if you exchange a contract in one name and decide before completion you wish to add in another, then I would suggest you doing that before completion taking place. Because once the title is registered, you want to add a name, remove a name, capital gain tax will come into play, stamp duty will come into play. So there's a lot of added cost.
Okay. So again, always go back to this magic message. Make informed decision. Don't simply purchase a property without a proper planning in your mind. Okay,
and
next
it's better
slide.
to put in, sorry, just to add, it's better to put in a lot of names first and remove whoever you wish, as opposed to adding. Because
you can add my name. I don't mind. I just don't want to pay.
And then remove it prior to completion.
Okay, joke aside. Now, this is a very important page as well. Remortgage and update your will. Christine, please, over to you.
Yeah, okay. Yes, so so for inheritance tax purposes, we will only consider the value of an asset after any debt secured against it. So if you pass a property worth £800,000, which still has an outstanding mortgage of £200,000, then effectively you are just transferring £600,000 when it comes to calculating your inheritance tax liability.
So always get mortgage.
Yes,
always get mortgage. Don't think about cash buy all the time. And a lot of clients like, I have a lot of money, I don't want to get any mortgage. But please, mortgage does help a lot. It does help mitigate a lot on the IHT as well. So this is something that you should consider. You probably don't like paying interest to the bank, but when it comes to a point that you realize that, oh, the tax rate on the IHT is too high, you will wish that you have taken a mortgage.
Yeah, so that is if you don't take a mortgage at the beginning, then perhaps you can take it out after. So
Yeah.
is it still deductible if you do like a refinancing? So by default, it's actually no longer deductible, but you can actually restore this if you update your will to contain provisions to ensure that arrangements are made to repay the debt upon your death. So this is
Okay.
a very good point to take note of.
So the mortgage option, I just want to be sure, it doesn't need to be UK banks, right? It can be any financier, any lenders in the world.
Yeah.
Okay, good.
Problems,
So there's no
yes.
limitation on the lenders. So you can get the remortgage from Malaysia. So Susie, you have got this question being answered. There's another question coming from this client. There's no inheritance tax between husband and wife. What if it's actually a joint ownership between parent and child? There is IHT.
Yeah,
There
so
is.
there is, yes. It's only between spouses. There's
Correct.
yeah.
Yeah. So the seven years survival rule is actually very important for you to consider.
Yeah.
And you have to live very healthily for the next 7 years.
You got outlive the 7 years.
Correct. Yeah. And also one very important question, I always get that from clients. When do you actually pay inheritance tax? When do you actually pay it, or just is via an executor or estate planning,
Yeah.
some
So
appointed person?
because you have already passed on, so you don't actually come up with the money, but your
Yeah.
next of kin will have to come up with the cash. Unless they decide to sell the property and then use the funds to pay off some of the inheritance tax bill, which I don't think it will leave much cash in the end. The tax rate is so high. Yeah.
But is there a specific period for them to comply to pay for the IHT from death? Within how long they have to pay for this?
This one I'm not exactly sure, but what I know is that it takes very long for them to actually process the probate and everything
I
else.
believe so. Because
Yeah.
do they have to go through court? Because in Malaysia, you would have to go through a court process in order to determine the transfer of the estates, and that's how it also determine on the taxes payable. And I'm not sure whether it's going to be the same process in the UK. Honey, if you want to add in, you can also add in
Yeah.
your points. Is that a court process? Is that a court process? Would there be a court process when it comes to inheritance tax payment?
Okay, so usually if you don't declare this, then at the time when you want to sell the property, it will be difficult because the land registry will require a death certificate. So, and then obviously this will take process. So, for instance, if your parents die and the house is still in their name and the children wants to obviously probably sell it to gain the proceeds or whatnot, they are unable to do so without the proper appropriate, the usual way of proceed the probate process. It does take time. I can't comment as to how long. There may be you maybe need to go into courts if there's certain documents or certain things that needs to be declared within the UK courts, but essentially this is, each individual will vary.
It varies. Yeah, definitely it varies.
Yeah, but essentially it'll be the executor, the will handle everything.
So the rule of thumb is always make will. Without will, it's hard to process your assets, your estates, or whatever arrangement you may have. So it can be arranged between some will company, or you can also do it via the lawyers as well. So Honey, not sure whether your company offer that, but otherwise if you want to have some Yeah, so best to have a will arrangement. Even though how young you are, how old you are, it is best to have the arrangement in hand. Okay, now next slide is the basic of UK property ownership structure. Christine, do you want to go through this very quickly?
Yeah, oh, okay. So I have added this in because we often get this question from clients. So would it be better to hold property under my own name, or should I buy it under a company? So there is actually no definite answer because it really depends on the purpose of your investments. So for this webinar, I have listed the differences from a UK tax perspective for you to think about before you decide whether to purchase a property under your individual name or a company. So I think for now, perhaps we won't go into the details here.
Yep. But I think there's one thing that clients can also understand is the items for tax deductible when it comes to tax filing, income tax. What kind of cost can they deduct for income tax?
Income tax, okay, we will talk about the rental income here, for example.
Yeah, rental income.
Yeah, so as long as the expenses are incurred wholly and exclusively in the production of the rental income, these can be deductible. So maybe examples are your letting fees, your agent management fees, any legal fees in relation to the drafting of the rental contracts, any repairs and maintenance expenses. So if let's say you are doing a renovation as an improvement to the property itself, then these will be considered as capital expenses.
Capital.
Yeah.
Very similar to Malaysian tax filing. Very, very similar. Nothing complicated. Okay, that's very straightforward. The next slide, I think there is questions coming from the client who asks whether they can buy under
sorry, the
company.
Yes, the stamp duty in the companies.
Correct. Yes.
Yes. So with owning a property under a company name, so there will be a flat rate of 15%. So it's a very, very high percentage to pay for stamp duty. This is if you are buying a property in the company name for your own benefit, for your children, your wife, whoever, friends to stay in there. Then on completion, you pay a 15% flat rate. However, if you buy a property in the company name for the purpose of renting, letting it out for investment purposes, then it will be on the usual stamp duty rules. However, there will always be a 3% surcharge. If the directors are also non-UK resident, then you will have to add in the additional 2%. So actually the stamp duty will be roughly about the same, 5% surcharge beyond that.
Yeah. So we actually will still encourage our clients to go into individual names basis if you don't intend to build a sizable portfolio. You want to start from the very basics, from owning one property to 2 and 3 in the next 10, 15 years. Individual basis is good enough for you to be more tax efficient. So that's our summary. For those who are still wondering whether buying through a company can be more tax efficient, that really, really depends. We have clients who are also asking whether SPV can be more tax efficient. It also depends. I think the tax is more on the corporate tax basis instead of income tax. And again, if you want to explore SPV, that sort of ownership structure, you can always drop us a DM. We can, direct you to the right person to deal with this with you. Okay. Yes.
There is someone asking about the personal allowance. Just to let you know, the personal allowance is per individual. So if you buy with your wife or husband, you each have an allowance of £12,750 per person. So if you buy the property in 4 names, you get,
each of you will get 12,000. Each of you. Even though if you're owning a property as a single owner, you also get 12,000. If you have
each individual,
if there are 3, each tax file per annum, so you get the full allowance for yourself. And if you are a UK resident, will you be taxed globally or worldwide income? For worldwide income?
Just
Not that I
UK,
heard of.
UK,
Yeah,
just
just
the UK
UK.
income. Whatever you receive in the UK is what you're going to be taxed on income tax.
Hmm. Okay, there should be a personal tax allowance if the property is co-owned by the couple, then the income will split equally. Yes, it will
No,
be split
no,
equally.
the personal allowance is per
Not for
individual.
per individual, yeah. But
Income
for
will
the
be,
income, yes, income,
yeah,
yes. Income will be split equally, and
yes.
the same goes to expenses. Yeah, hope that
Yeah,
answer your question,
depends
Ryan.
on the, yes, it depends on the percentage of ownership, basically. So we have clients who own property. It's really weird. So it's maybe like 40%, 40%, 20%. So the income will just be split accordingly.
Okay, maybe the 20% owner does less work. So okay, understandable. Yeah, but really according to the percentage of the share lah. If it's a tenants in common, that sort of basis. Can I sell my property to my child at below market value to reduce either capital gains tax or inheritance tax? Ooh, okay. I don't think so.
It's on market value. It's on market
Yeah,
value. So you have to
it has to be.
declare it to the inland revenue on the market value of the property at that time. So it's yeah. No. Our comment is
Sorry.
no. No.
I wish we could, but no, it's against the market practice. Yeah. Okay. We will open for more questions later on. I would like to take this opportunity for a quick commercial break. Because we are actually doing a project launch this weekend, and we are honored to have also Hani and Christine to be supporting the event as well over the weekend. This is Camden Goods Yacht. Let's have a very quick briefing on the location first. I think Camden itself is no stranger to a lot of people, especially for, I wouldn't say older generation, but maybe in the early days, those who study in the UK would have a special sentiment towards Camden, especially areas in Primrose Hill, Regent's Park, like Streets Cottage. Basically, this property itself is nestled in the South After Camden area of North London, and it's actually 999 years leasehold, mixed-use development, spanned across 8 acres of land, and it's actually situated in a Golden Triangle in between Camden Town, Regent's Park, and also Primrose Hill. Okay, we are basically just next to Camden Market, and it's walking distance to Chalk Farm Station, 6 minutes walk, and about 8 minutes walk to Camden Road Station. First, I would like to address why Camden is so popular among international investors. There are a couple of reasons which I have put together. Now, number one, strategic location. Zone 2 is located in the heart of London, Zone 2, and making a very prime location for business. It is well connected with public transport, including the London Overground and also Underground. We have Chalk Farm, as I mentioned, and also Camden Town Tube Station, and also buses along the high street. It makes it very easy accessible for both residents and tourists. And number two, we have factor on cultural and historical appeal. Those who have been to London, I'm sure you have been to Camden Market as well. It has a very rich cultural and historical heritage. And the area is known for the iconic markets, including the Camden Market and also Camden Lock. And they attract a large number of tourists. It has a very vibrant music scene, art scene, music venues, famous Roundhouse Theatre, which also contribute to its cultural appeal. Number three, tourism and retail. I'm sure you also see a whole stretch of local shops, independent shops, major tourist hub, attracts millions of investors each year. So the presence of popular tourist attractions such as Camden Market and Camden Lock offers a significant opportunities for retail and also hospitality business, and also attracts a lot of foot traffic. Number 4, creative and tech hub. So Camden has a growing reputation as a creative and tech hub in London. Is actually a home to numerous startups, tech companies, and creative industry. So it makes a very attractive place for international investors looking into tap into these sectors. It is also super close to King Cross Station, which is now London's biggest and buzziest tech hub. It's also home to Google. To be precise, Google HQ is there. We have YouTube and Facebook as well. So that creates like 1,000 job opportunities in the area for the next 20 years. Education and innovation. So Camden hosts several education institutions. That includes University of London and also UCL. I have spoken to a couple of parents the past few days, and all their kids are basically in UCL. That foster innovations and attract international students and researchers. So this educational ecosystem can lead to collaborations and investment opportunities. Number 6. Here we go. Infrastructures and regeneration. So Camden has seen significant infrastructures development and regeneration projects in the recent years. In fact, this Camden Goods Yard sits within the regeneration opportunity area. So these initiatives have already improved the overall quality of life, transportation, and also urban amenities. So it makes it an even more attractive destination for investors. So Camden Goods Yard, it is set to be completed in phases. And the best thing is we are actually launching phase 1. And I think all Malaysians love phase 1 because we love to be early bird. The completion of phase 1 will be in Q2 2025. And the entire completion itself will bring about 644 new homes into the neighborhood itself. So this Camden Goods Yard basically takes its name from a 19th century depot that once stood on site, and it was the original terminus for railway goods traffic. So it has a lot of historical value. And it was built to a master plan by Allies and Morrison, with sustainability and community building in mind. Developer St. George, they're part of Berkeley, which is no stranger to most Malaysian investing public who have already invested in the UK. First phase of the development, Primrose House, if you can see my cursor here, these two, it will feature 110 residents, comprising studios, 1, 2, and 3-bed apartments. And the apartments are housed in 2 towers, spanning 14 and 11 story that shares a podium garden in between. In addition to apartment blocks, there is going to be 173,000 square feet commercial space. That includes flexible office space and also light industrial workshops. There will be a Morrison's on site at 48,000 square feet. It's actually a supermarket, a huge supermarket on site, and a rooftop farm to fork restaurant. It's quite iconic, basically. So about 40% of the site will be dedicated to hard and soft landscaping, which is very green. I think currently people are all talking about green landscape, green corridors within the development. This sort of requirement actually become more prevalent after COVID, because I suppose that contributes a positive growth to your mental health as well, which is a fact. Now, there is also going to be a Regency Club, which house most of the amenities for the residents. Let's dive into that. This is a few CGIs that will explain why Regency Park is very special. They have a wellness suite, they have swimming pool, steam room, sauna, 24 hours concierge. They have 3 screening rooms, the private cinemas. In addition, there is also residence lounge and also co-working space. And gymnasium, state-of-the-art, huge gymnasium on site. 18-meter swimming pool with spa and sauna facilities. And let's get into the specs. Units will come fully fitted. You have the choices of the color scheme as well. But in essence, you just have to buy removable furniture. For example, the sofa, the dining tables and chairs, the beds, all the cabinetries, the flooring, the cooktop, appliances will be all given and they will come together with the apartments. Some apartments will have the skyline view over the London city as well, which looks really amazing. In essence, we are talking about 8 acres of land and it's only 644 homes. In terms of plot ratio, is very generous, I would say. Excellent transportation. You have Chalk Farm and Camden Town Underground, all within 10 minutes walk. I walk there myself. I can testify, even with Malaysian speed, I can get to the station under 10 minutes. You know, Malaysian walk very slow, right? Not Singaporean. So yes, I can testify that. The office space is something that I really like to take note as well. And I would like for you to also consider that as a positive selling features to the development. With mixed use purpose, it brings a lot of foot traffic. It brings a lot of attention to the development. And that brings about rental demand as well. And the developer has also mentioned that the profile of the commercial tenants will be very specific in that sense that they will only handpick the commercial tenants. Not any other people can come in and rent. They will only pick on the business which are thriving, good brand, good profile. And then from there, you can attract your rental demand from these people. It is car-free development, very bio-friendly in that sense. There is going to be a market house as well, rooftop terrace. There's the restaurants on top, which is open to the public, and they cook via their local produce, which is pretty cool idea. There is going to be a railway arches on site, which will provide a direct access to the market, and also 5,000 square meter of affordable workspace. Again, foot traffic, rental demand. Look from the investment point of view. And it's also within access to Camden Town, Camden Market, and also a 46,000 square feet Morrison supermarket. So literally, it's a very self-sufficient community. You don't have to go out into central London to buy your grocery or to do your daily errands. Everything can be done via walking in Camden itself. So if you're interested, before I wrap up our sharing today, we would like to invite you to come and meet us as EQ Hotel this weekend for a no obligation consultation. You can see a QR code from here. This leads you to my WhatsApp if you wish to RSVP with us for a one-on-one consultation. We will be there from tomorrow onwards, from Friday to Sunday. And if you wish to meet Christine and Hani for a personal consultation on tax and also on legal, let us know. Text me. That's a QR code again. Text me and I will do the arrangement for you. I hope that you will find all the information shared today useful. When you are doing your wealth planning, and if you feel that we have resonate with you well, please don't forget to subscribe to our social media account as well. And also let us know if you would like to schedule a private consultation like I mentioned. We would love to be part of the investment journey. So let us know. More than happy to help. Thank you again for joining us today. I'm going to leave our contact details here. Let me see. We do have some Q&A. Yes. Let me see. Have we all answered? Yes, we have answered all, I suppose. 1, 2, 3. Answer live. Just want to double check we have answered all the questions. And how much is the candle? Oh, yeah, there is some message in the group chat. Honey used to win Rhythm Shuffle. I mean, she's still with Rhythm Shuffles. I've known her since Rhythm Shuffle since 2013. It's been 10 years of friendship.
A decade of
yeah.
friendship.
Yeah.
A decade of friendship.
Exactly. She's very loyal as well. Very loyal. Hands up. Like I will testify for her. Oh, is she still there? Yes, she's still there. How much is the Camden property? Do you want to DM me? Oh, you actually handle his property purchase, Brian Chow.
All right.
Ah, small world. Small. I mean, to be fair, Honey handles most of the Malaysian buyers, monopolized.
Mm.
No, it's because I can speak the language as well, probably.
Yes, exactly. And she has the Malaysian Boleh spirit as well.
The
That's very
Malaysian
important.
mentality.
Yes, yes, yes. So the Camden property, very interesting. Starting price from 725,000 pounds. 725. It is a very unique, very benchmark property. Trophy collection. So if you are interested, I would love for you to come and see us over the weekend. We have the skill model. We also have the sales director who purposely flying to meet our clients this weekend. He was through all the planning process from day one. So he was telling us that because this area is basically a conservation area, so there are certain planning restrictions. And St. George being St. George, Berkeley being Berkeley, they are able to overcome the obstacles. And I mean, for them to compensate is to put more green corridor in the development, which they managed. In the end, they got it approved, and then we have these wonderful developments that we are launching in Malaysia. So again, please reach out to us if you wish to come by and see us. Christine will be with us until no, she'll be here on Saturday, from Saturday until Sunday 1 p.m. So if you want to grab her for a chat, for taxation, buy her coffee, come and see us. Let us know. And Honey will be with us throughout the weekend as well. Okay, that pretty much wrap up our sharing today.
Thank
Thank
you
you
so much,
again for
Shelvin.
joining us today. No problem. I hope
Thank
this is
you,
a
Shelvin.
very light, not heavy dialogues. We probably should consider doing podcast together next time. Yeah,
We
okay.
should.
That's a deal.
All right. Thank
Set.
you, guys.
Thank you,
Bye-bye.
and have a good
Thank
week
you,
ahead,
everyone.
everybody.
You
Bye-bye.
too. Bye.
Bye.